the last 90 days, over 40% of homes listed in certain Sunbelt markets sat on the market for more than 60 days without an offer. Not because buyers disappeared, but because the math stopped working. A home that sold in 2021 with a monthly payment of $1,400 now costs the same buyer over $2,800 a month for the exact same property. That single number, that monthly payment wall, has quietly restructured every housing market in America. And in 10 specific cities, the pressure building beneath the surface is unlike anything we've seen since 2008. Not for the same reasons, but with a familiar result. What you're about to hear is not a prediction of collapse. It's an analysis of structural imbalances. Markets where supply grew faster than the people or jobs to fill it, where investor capital moved in waves and may now be moving out, and where the psychology of buyers has shifted from urgency to hesitation. That hesitation, when it compounds, becomes something else entirely. Let's start with the context. When mortgage rates sat near 3%, buyers could stretch. A $450,000 home felt accessible. At 7%, that same home demands a payment nearly double. Most existing homeowners who locked in at 3% have effectively become prisoners of their own good fortune. They won't sell because selling means trading a cheap mortgage for an expensive one. That lock-in effect has strangled resale inventory in most of the country, but in the markets we're about to cover, builders kept building anyway. They broke ground in 2021 and 2022 when demand was real, and those units are now delivering into a market where the buyer pool has dramatically shrunk. The result? Inventory is rising, days on market are climbing, price reductions are becoming standard, and sellers are offering concessions, rate buydowns, closing cost credits, free upgrades that didn't exist 2 years ago. When concessions come back, the correction has already begun. It just hasn't been priced in yet. Here's where it's happening. Number 10, San Antonio, Texas. San Antonio flew under the radar during the pandemic boom. It lacked the cultural cachet of Austin, the corporate relocations of Dallas, the coastal anxiety of Miami, but builders noticed something more important: cheap land, low regulation, and a steady stream of military families and remote workers looking for affordability. Construction accelerated. The problem is that absorption, when the actual rate at which units are rented or purchased, never matched the pace of delivery. Today, San Antonio has a growing backlog of new units with occupancy rates that developers quietly acknowledge are below their pro formas. Landlords are offering 1 to 2 months of free rent just to get leases signed. For buyers, sellers are competing against brand new inventory that has better finishes, builder incentives, and no deferred maintenance. The specific risk here is unit commoditization. When every block has 3 nearly identical homes built by national builders, the comparable reset is brutal. One price cut resets all of them. Number 9, Orlando, Florida. Orlando's housing story is inseparable from its tourism identity, and that identity is both its engine and its vulnerability. The market attracted investors who saw short-term rental income as a reliable stream tied to Disney, Universal, and the convention economy. Then, 3 things happened simultaneously. Short-term rental regulations tightened in surrounding counties, insurance premiums in Florida surged following hurricane seasons, and a wave of new multifamily construction hit the market starting in late 2023. Vacancy rates in Orlando's rental market have been climbing steadily since 2024. The investor who bought a 3-bedroom near International Drive for $380,000 in 2022, counting on Airbnb revenue to cover the mortgage, is now running the numbers again. And they don't work. When those investors decide to exit, they don't exit slowly. They list, they price to move, and they create comps that drag down the entire neighborhood. The specific risk in Orlando is investor concentration in short-term rental corridors. The unwind there will be faster than a typical residential correction. Number 8, Raleigh, North Carolina. Raleigh earned its reputation as a tech and education hub with real fundamentals, research triangle, strong university anchors, growing biotech presence. The boom was legitimate, the overshoot was not. Construction started in 2021 and 2022 based on population projections that assumed pandemic-era migration would continue indefinitely. It didn't. Remote work policies tightened at the very companies recruiting into Raleigh, and the office return requirement quietly reduced the mobility that drove so many relocation decisions. New apartment buildings are delivering into a market where lease-up timelines have doubled. The specific structural risk in Raleigh is its dependency on a relatively narrow employment base. If the tech hiring cycle cools further, the demand thesis that justified all that construction weakens fast. Days on market for single-family homes have increased significantly. Price reductions, once rare in this market, are now listed openly on MLS without apology. Number 7, Charlotte, North Carolina. Charlotte plays a dual role in the Southeast economy, financial center and logistics hub, and that diversification gave it insulation that other markets lacked. But even diversified economies have limits when construction simply outpaces the population. Charlotte's multifamily pipeline has delivered tens of thousands of units over the past 2 years, and the absorption rate, while reasonable, hasn't kept pace. The nuanced risk in Charlotte is what happens at the upper end of the market. Luxury and Class A apartment buildings are competing for the same renter. The young professional earning $80,000 to $120,000, and there are simply more units than renters at that income level. Concessions have normalized. Free parking, waived deposits. First month free. When concessions become permanent features of a market, effective rents are lower than asking rents, and that gap eventually shows up in valuations. For investors who underwrote deals at 2022 rent assumptions, the math is quietly breaking. Number 6, Tampa, Florida. Tampa was the darling of the pandemic relocation story. Low taxes, warm weather, comparatively affordable prices, and a downtown that was genuinely improving. It attracted retirees, remote workers, and institutional investors simultaneously. Then came the insurance shock. Florida homeowners' insurance costs have risen dramatically over the past 3 years, driven by reinsurance costs, litigation reform battles, and repeated storm damage. In Tampa specifically, sitting directly in a hurricane vulnerability zone, annual insurance premiums that were $2,000 in 2019 are now routinely hitting $6,000 to $9,000 for comparable homes. That cost doesn't show up in the listing price. It shows up in the monthly payment calculation, and it has pushed effective affordability past the breaking point for a large share of potential buyers. The specific risk here is insurance-driven demand suppression. Even if a buyer can afford the mortgage, the total carrying cost has become prohibitive. Inventory has risen sharply. Sellers who priced for 2022 demand are sitting. And unlike other markets, this isn't a rate problem that resolves when the Fed cuts. The insurance cost is structural. Number 5, Atlanta, Georgia. Atlanta is big enough and economically diverse enough that its problems are easy to dismiss, but the data is telling a clear story. Multifamily vacancy in Atlanta's metro has climbed meaningfully since 2023, following one of the most aggressive construction cycles in the city's history. Developers built for a migration thesis, people leaving expensive northern cities for Atlanta's relative affordability. And while that migration happened, it did not happen at the volume or the income level that was underwritten. The specific risk in Atlanta is demographic mismatch. Many of the new units being delivered are Class A buildings targeting renters who earn $70,000 or more. But Atlanta's in-migration has been more economically mixed than the pro formas assumed, and the upper-income renter cohort is smaller than projected. The result, Class A buildings are offering 2 months free rent, while Class B and C buildings are feeling secondary pressure as renters upgrade for free. That chain reaction suppresses rents across an entire market segment. Number 4, Dallas-Fort Worth, Texas. Dallas-Fort Worth is the largest single construction market in the United States by unit count. That fact alone deserves attention. DFW has delivered, and continues to deliver, more new residential units than any comparable metro. The corporate relocations were real. Toyota, Goldman Sachs, Caterpillar, and dozens of others brought legitimate jobs and legitimate demand, but the volume of new construction has outpaced even that remarkable demand signal. Absorption is lagging. New home builders are offering mortgage rate buydowns, cash incentives, and design upgrades to move inventory that would have sold in days in 2021. The specific risk in DFW is scale. When a market this large begins to correct, the comparable resets affect hundreds of thousands of units simultaneously. A price reduction in one master planned community forces a reduction in the one 5 miles away. Builders, unlike individual sellers, have to move units to survive. They will cut prices before a typical homeowner will, and in DFW, builders represent a disproportionately large share of available inventory. That means the reset, when it comes, will be set by corporate pricing desks, not by emotional sellers who love their home. Number 3. Austin, Texas. Austin was the defining market of the pandemic housing boom. The story was irresistible. Tech migration, remote work, culture, growth, youth. Home prices nearly doubled in some submarkets between 2020 and 2022. Then reality arrived. The tech companies that sent employees to Austin began requiring office returns. In Seattle, San Francisco, and New York, not Austin. The population growth, while real, never matched the construction response it triggered. Today, Austin has one of the highest inventory levels among major metros, and the correction is well underway. Median prices have declined meaningfully from peak. Days on market have expanded dramatically, but the deeper issue is psychological. Austin broke the belief in its own inevitability. Buyers who felt they had to rush, who waived inspections and offered above list to compete, now see the same homes sitting unsold for 90 days. That shift in buyer psychology and from urgency to patience doesn't reverse quickly. The specific risk Austin carries is the reset of comparables in a market where peak prices were irrational. Every new sale at a lower price makes the previous high water mark harder to justify. Sellers who bought at the top face a difficult choice: accept losses or wait indefinitely in a market where the wait is getting longer. Number 2. Denver, Colorado. Denver occupies a peculiar position. Its fundamentals are genuinely strong: outdoor lifestyle, diversified economy, educated workforce. But the housing market was stress-tested in a way that exposed a structural vulnerability specific to Denver, a massive pipeline of multifamily construction that is still being delivered, even as demand signals have softened. Rental vacancy rates have risen sharply. Landlords who bought buildings in 2021 at cap rates that assumed 5% annual rent growth are now contending with flat or declining effective rents and concessions that compress their actual yield. The specific risk in Denver is financial leverage at the property level. Many of the multifamily buildings that delivered in 2023 and 2024 were financed with floating rate bridge debt, the type of short-term construction loan that refinances into permanent financing once the building stabilizes. Stabilization requires occupancy, and occupancy is taking longer than projected. When a loan matures and the building hasn't stabilized, the owner faces a choice: inject more equity, sell at a loss, or hand the keys to the lender. Denver has a quiet but growing number of these situations in its commercial real estate pipeline. The spillover into single-family residential will be indirect but real. Distressed multifamily sales reset land values, which affect builder confidence, which affects pricing across the metro. Number 1. Phoenix, Arizona. Phoenix is where every risk discussed in this video converges into a single market. Imagine a young couple, both remote workers, who relocated from California in 2021. They bought a 4-bedroom home in a new master planned community in the West Valley for $520,000. They put 10% down, locked in at 3.25%, and felt like they'd made the smartest financial decision of their lives. Their monthly payment was $2,040. The community was growing around them, new neighbors arriving weekly, a Target under construction a mile away. Now it's 2025. The husband's company mandated a partial office return in San Jose. The wife's employer went through layoffs. They need to think about moving. They list the home. The agent tells them comparable homes in their community have sold for $480,000 to $490,000 recently, down from their $520,000 purchase price. But there are 11 other homes for sale within a half mile, including 4 brand new builds from the same builder, offered at $465,000 with a 2-1 rate buy down and $15,000 in design upgrades. Their home is not special. It looks like all the others because it is all the others. They've been on the market for 47 days. They've dropped the price twice. They're offering $10,000 in closing cost credits. They still don't have an offer. This scenario is not hypothetical. It is happening across the Phoenix metro right now. Phoenix constructed more housing units per capita during the pandemic boom than nearly any other major market. The land was cheap, the regulatory environment was friendly, and the migration story, driven by California's cost crisis and remote work flexibility, felt durable. Builders responded rationally to the signals they had, but the signals were distorted by a once-in-a-generation rate environment that has since reversed completely. Today, Phoenix carries a combination of risks that no other market on this list matches in concentration. It has excess new construction supply still being absorbed. It has a high proportion of investor-owned single-family rentals, institutional buyers who purchased at scale and are now evaluating their exit timelines. It has a buyer pool constrained by the monthly payment wall. The same home that required $2,000 a month in 2021 now demands nearly $3,200. It has a symmetric inventory problem. Our sellers competing not just against each other, but against builders who have an economic incentive to cut prices to close out phases. And it has a geographic identity risk. Phoenix built its boom on the promise of affordability relative to California. That gap has narrowed substantially. The migration pressure that justified the construction thesis has slowed. The correction in Phoenix doesn't require a crisis event. It doesn't need a recession or a financial shock. It needs only time. Time for the math to become undeniable. Time for sellers to accept that the comparable reset has happened. Time for the investors, who are watching inventory data and cash flow statements far more dispassionately than families, to decide that holding is no longer the right call. When institutional capital begins to exit a market, it moves faster than retail. It doesn't wait for the perfect price. It moves in volume. And when large portfolios of single-family rentals hit the market simultaneously, they don't negotiate. They create the new comps. Phoenix is not going to zero. It remains a large, functional, economically diverse city. But for the investors and buyers who are making decisions right now, the structural reality is this: supply exceeds demand. The financing environment has transformed the buyer pool, and the psychology has shifted decisively from fear of missing out to fear of catching a falling price. That second kind of fear tends to be self-fulfilling, and in Phoenix, it has already begun. Every city on this list is telling a version of the same story. Construction followed optimism, optimism followed cheap money, and cheap money is gone. What remains is inventory, carrying costs, and a buyer who now has the time and leverage to be patient. The question worth asking, and we want to hear your answer in the comments, is this: if you were making a real estate decision today in any of these markets, would you be a buyer, a seller, or someone waiting on the sidelines? What would have to change to move you? If this analysis changed how you're thinking about the housing market, share it with someone you know who's considering buying or selling in the next 12 months. They may not have seen the data yet. And if you want more content like this, economic analysis that respects your intelligence and doesn't pretend the future is obvious, subscribe. We're paying attention so you don't have to do it alone.